So we figured it would be helpful to talk about some specific companies just to get a sense of how you would compare a balance sheet between several different companies. So the two that we wanted to highlight are Pfizer and Bristol Myers Squibb, which you'll hear us refer to as Bristol, BMY, easier than saying the whole thing. So the common thread between these two companies is that they're partners on a next generation blood thinner called Eliquis. Eliquis was approved in late 2012 and has had kind of a slow ramp up, but it's doing really well now. Last quarter alone, there was, I want to say 466 million in sales of last quarter for Eliquis. So that's your common thread there.
Yeah, you look at drugs that are growing very quickly. It's very hard for blockbuster drugs, billion-dollar drugs to keep growing fast because obviously they're being used in more and more patients. But, Eliquis is a very interesting drug because, warfarin has been used as the mainline anticoagulant for patients for 50 years. And now Eliquis, which is a factor XA inhibitor, works very differently, is starting to really eat into that market share. That sales have doubled in the last year. So you look at it, you say, okay, we've got a company where sales are more than doubling on a drug. Which of these two companies, they split profit on this drug equally, which of these two companies might be the better investment if I want to have exposure to this drug? One of the ways you can help determine that is by looking at the financial health of the company, which we've already established involves checking out the balance sheet.
Exactly. So with that, let's dig right in. One of the first metrics that I like to look at when I'm considering a balance sheet is called the current ratio. So the current ratio basically tells you whether or not a company can pay back its short-term liabilities using its short-term assets. How exactly is this calculated?
This is a quick and dirty, it's a great ratio for investors to look at just to say, okay, if creditors come knocking, how likely is it that the company is going to be able to pay them? So it's a great, it's like a measure of liquidity, okay? It tells you whether or not a company is likely a year from now or within this year to remain solvent. If you have a current ratio that is below 1, you should be nervous. If you have a current ratio above 1, it's okay.
Of course, and you can tell that just from looking at the actual calculation of current assets divided by current liabilities, that 1 is really your benchmark there of can you meet these obligations with current liquidity?
Right. And again, investors don't have to do this calculation on their own unless they want to. Plenty of websites that are free online will provide this to you under key statistics or some other area of their website.
And so when you look at the two companies that we've been talking about, Pfizer has a current ratio of 1.61, which sounds pretty good. That's above 1. But then you look at Bristol, and they are posting 1.81. So advantage Bristol there.
Yeah, advantage to Bristol on this measure, but it is important to note that both of these companies look good on this measure. Again, above 1 means that there's no short-term risk to them being able to handle their obligations. As an aside, too, because you may run into this as an investor and you're considering healthcare stocks, if you end up with a current ratio that's too high, that could be a sign that they're having a hard time figuring out what to do with their money. And they're not reinvesting that money in something that's going to provide net income growth down the line. So you almost want to have a Goldilocks kind of current ratio, and I usually define that as between 1 and 3. So both of these companies are fine at 1.61, 1.62 for Pfizer and 1.81 for Bristol, but we'll give the edge to Bristol on this one.